If you own physical gold or silver right now, you're sitting on a decision that could define your financial future. And I'm not being dramatic here. What's happening in the precious metals market right now is something most people won't see coming until it's too late. The question isn't whether you should own bullion anymore. The question is what you do with it next, because the landscape has fundamentally changed. Let me show you what I mean. Gold just completed one of the most remarkable years in its history. We're talking about a metal that hit over 50 all-time highs in a single year. 50. Think about that for a second. This isn't some speculative cryptocurrency or tech stock. This is gold, a 5,000-year-old store of value that supposedly moves slowly and predictably. Except it's not moving slowly anymore. It's accelerating. And silver? Silver's been quietly building pressure like a coiled spring, with industrial demand reaching levels we've never seen before. But here's where it gets interesting. While retail investors were watching stock market headlines and debating whether we're in a recession or not, something else was happening behind the scenes. Central banks around the world have been accumulating gold at a pace that would make your head spin. We're not talking about small purchases here and there. We're talking about systematic, aggressive buying that's been going on for years now, and it's accelerating. The People's Bank of China has been adding to their reserves month after month. The Reserve Bank of India is buying. Poland's central bank is buying. Turkey, Singapore, the Czech Republic. Countries that historically held minimal gold reserves are suddenly scrambling to acquire as much as they can get their hands on. Why? What do they know that the average investor doesn't? Before I go any further, I want to mention something quickly. I've put together a free guide that breaks down the wealth protection strategies that thousands of American retirees are using right now. It's in the description below. No cost, no obligation. Just information that could be valuable for your situation. All right, back to what's happening. Here's the thing about central banks. They don't make emotional decisions. They don't panic buy. They don't follow trends on social media. When central banks move in unison like this, they're responding to something structural, something fundamental. And what they're responding to is the slow motion collapse of the dollar-based monetary system that's been in place since the end of World War II. Now, I know that sounds extreme, but let me walk you through what's actually happening. The BRICS nations, that's Brazil, Russia, India, China, and South Africa, plus about 40 other countries that have expressed interest in joining, are actively working to create alternative payment systems that bypass the dollar entirely. They're not doing this because they hate America. They're doing it because they've watched what happens when you're dependent on a currency that can be weaponized through sanctions, that can be devalued through unlimited money printing, and that's controlled by a single nation's central bank. Think about it from their perspective. You're a finance minister in a developing country. You've seen Russia get cut off from SWIFT. You've watched the United States add trillions to its money supply in just a few years. You've seen the dollar's purchasing power erode. What's your logical move? You diversify. And the oldest, most proven diversification in human history is gold. But there's another layer to this that most people miss. The gold market isn't just about central banks and geopolitics. It's about physics, actual physical supply and demand. And right now, we're seeing something that hasn't happened in decades. The amount of physical gold available for delivery is shrinking while demand is exploding. Let me explain how this works. Most gold trading happens on paper. Futures contracts, ETFs, derivatives. For every ounce of physical gold that actually exists, there are probably 100 claims on that same ounce through various paper instruments. This system works fine as long as everyone's content to trade paper and nobody actually wants to take delivery of the metal. But what happens when that changes? We're starting to see the answer. The COMEX, that's the major commodities exchange in New York where gold futures are traded, has been experiencing something unusual. The amount of gold in their registered vaults, the gold that's actually available for delivery against futures contracts, has been declining. At the same time, the open interest, the number of contracts that could potentially demand delivery, has been rising. This is what traders call a squeeze setup. Now, I'm not saying the COMEX is going to default tomorrow, but I am saying that the mechanics of the physical gold market are getting tighter. And when markets get tight, prices tend to do interesting things. We saw a preview of this during the pandemic, when premiums on physical gold coins and bars exploded. Dealers couldn't keep inventory. Wait times stretched to weeks or months. The paper price said one thing, but if you actually wanted to buy a gold coin, you were paying significantly more. Silver's situation is even more interesting, and frankly, more precarious. Silver has this unique characteristic where it's both a monetary metal and an industrial metal. About half of all silver mined gets used in industrial applications: solar panels, electric vehicles, electronics, medical equipment. And here's the kicker: most of that silver is used in such small quantities per application that it gets lost. It's not economically viable to recover it. So unlike gold, where almost every ounce ever mined still exists in some form, silver is actually being consumed and removed from the available supply. The solar industry alone is projected to use massive amounts of silver over the next decade. Each solar panel requires silver for its photovoltaic cells. As countries push for renewable energy, that demand isn't optional, it's structural, and it's competing with investment demand, jewelry demand, and all the other traditional uses of silver. Meanwhile, silver mining hasn't kept pace. Most silver comes as a byproduct of mining other metals like copper or zinc. You can't just decide to mine more silver when the price goes up. It doesn't work that way. So you've got declining available supply, increasing industrial demand that's not price sensitive, and now you're adding investment demand on top of that. The silver market is a fraction of the size of the gold market. It wouldn't take much capital flowing in to move the price dramatically. And when I say dramatically, I'm talking about moves that would make the last few years look tame. Let me tell you a story that illustrates what can happen when physical markets get tight. Back in the late 70s, the Hunt brothers tried to corner the silver market. They accumulated massive positions in physical silver and futures contracts. At one point, they controlled a significant portion of the world's deliverable silver supply. The price went from around $6 an ounce to over $50 in just a few years. Now, the Hunt brothers eventually got crushed when the rules got changed and margin requirements got raised, but the point is, silver can move fast and violently. We're not in a Hunt brothers situation now. What we're in is potentially more significant because it's not one or two wealthy individuals trying to manipulate a market. It's fundamental supply and demand dynamics playing out across the entire global economy. It's central banks diversifying reserves. It's industrial users securing supply. It's investors recognizing that the monetary system is changing. Here's where your decision comes in. If you own bullion right now, you're ahead of the curve. You recognize something that most people still don't see. But owning it is just the first step. The question is, what's your strategy from here? Are you holding for the long term? Are you looking to add to your position? Are you thinking about how this fits into your overall wealth protection plan? Because here's what a lot of people don't realize. Owning physical gold and silver is different from owning stocks or bonds or real estate. It's not about yield. It's not about cash flow. It's about preserving purchasing power through periods of monetary instability. It's about having something that can't be devalued by a central bank's printing press. It's about insurance. Think about insurance for a second. You pay for homeowners insurance every year, and you hope you never have to use it. But you keep paying because the alternative, having your house burned down with no coverage, is unacceptable. Precious metals work the same way. You hold them hoping you never need them to perform their insurance function. But if the monetary system goes through a major reset, if we see serious inflation or currency devaluation, if there's a financial crisis that makes 2008 look like a warm-up act, you'll be very glad you own physical metal. Now let me address something that comes up a lot. People ask, isn't gold expensive right now? Didn't it just hit all-time highs? Shouldn't I wait for a pullback? And look, I understand that psychology. Nobody wants to buy at the top. But here's the thing about all-time highs in gold. They're not like all-time highs in a stock. When a stock hits an all-time high, it might be overvalued. It might be in a bubble. It might crash back down. But gold hitting all-time highs is different. Gold hitting all-time highs is often a signal that something is breaking in the monetary system. It's not that gold is getting more valuable. It's that the currency you're measuring it in is getting less valuable. The gold is just sitting there being gold, same as it's been for thousands of years. It's the dollars, or euros, or yen that are changing. And when you look at gold priced in other currencies, it's been hitting all-time highs for years. The Japanese yen, the British pound, the euro. Gold has been screaming warnings in those currencies, while dollar-based investors were still debating whether it was a good time to buy. By the time something is obvious to everyone, the easy money has already been made. Let me give you another perspective on this. If you bought gold back when it was a few $100s an ounce, congratulations. You did great. But even if you bought at the previous all-time high back in 2011, you're still up significantly from here. And more importantly, you preserved your wealth through a period where the dollar lost substantial purchasing power. Could you have timed it better? Sure. But trying to time the market perfectly is how most people end up doing nothing and missing the entire move. The smart approach with precious metals isn't about timing the perfect entry. It's about building a position over time and holding it as part of a diversified wealth protection strategy. Dollar cost averaging works with gold and silver just like it works with anything else. Maybe even better, because you're not trying to predict short-term price movements. You're systematically building a position in something that has intrinsic value and can't be printed into existence. Speaking of wealth protection, let me mention something for those of you who have significant retirement savings. If you're sitting on $100,000 or more in retirement accounts, there's a strategy you should know about. Gold IRAs allow you to hold physical precious metals inside your retirement account without triggering tax penalties. I've put together a guide that explains exactly how this works. It's in the description. Covers the rules, the process, the pros and cons. Worth checking out if that's relevant to your situation. All right, let's talk about what happens next, because this is where it gets really interesting. We're at a point in the precious metals market where several major trends are converging. You've got central bank buying at record levels. You've got industrial demand for silver accelerating. You've got geopolitical tensions driving countries to diversify away from the dollar. You've got physical supply getting tighter. And you've got a growing recognition among investors that the monetary system is changing. Any one of these trends would be significant. All of them happening at once? That's the setup for a major move. And I'm not talking about a 10 or 20% move. I'm talking about the kind of move that redefines what people think is possible in the precious metals market. Let me paint you a picture of what this could look like. Imagine a scenario where a major central bank, let's say China, announces they're backing a portion of their new digital currency with gold. Not a full gold standard, but a partial backing, just enough to give their currency credibility as an alternative to the dollar. What do you think happens to the gold price when that announcement hits? Or imagine a scenario where the silver supply situation gets tight enough that industrial users start panic buying to secure supply. We've seen this happen in other commodity markets: lithium, cobalt, rare earth elements. When industries realize they can't get the materials they need, price becomes secondary to availability. They'll pay whatever it takes to secure supply. Or imagine a scenario where inflation comes back with a vengeance. Not the modest inflation we've seen recently, but real, sustained, double-digit inflation like we had in the 70s. What happens to precious metals in that environment? We know what happened last time. Gold went from $35 an ounce to over $800. Silver went from $1.50 to $50. And that was with a much smaller monetary base and much less debt in the system. Now, I'm not predicting any specific scenario. I'm just pointing out that the setup exists for multiple potential catalysts. And in markets, it's often not about predicting which catalyst will trigger the move. It's about recognizing when the conditions are right for a move and positioning yourself accordingly. Here's what I think a lot of people miss about precious metals. They're not a get-rich-quick scheme. They're not about making a fast profit and getting out. They're about preserving wealth over long periods of time and protecting yourself against scenarios that most people don't want to think about. The people who do best with gold and silver are the ones who understand this and plan accordingly. Think about it this way. If you own a house, you probably have homeowner's insurance. If you own a car, you have auto insurance. If you have a family, you might have life insurance. All of these are protections against low probability but high impact events. Your house probably won't burn down. You probably won't total your car. You probably won't die young. But you insure against these things anyway because the cost of being wrong is too high. Precious metals are financial insurance. They protect against monetary system failure, currency devaluation, banking system collapse, geopolitical chaos. These are low probability events in any given year. But over a lifetime, over a generation, the probability that we see some kind of major monetary disruption is actually pretty high. And the cost of not being prepared is potentially catastrophic. So when you're thinking about your bullion holdings, think about them in that context. This isn't money you're trying to grow aggressively. This isn't your retirement account that needs to compound at 8% a year. This is your insurance policy, your backup plan, your plan B for when plan A doesn't work out the way everyone expects. And here's the beautiful thing about precious metals as insurance. Unlike regular insurance, where you pay premiums and hope you never have to use it, precious metals have intrinsic value. Even if none of the catastrophic scenarios play out, you still own something real, something that's been valued for thousands of years, something that can't go to zero, like a stock or a bond or a currency. Let me tell you about something that happened during the financial crisis in 2008. I know people who had significant wealth tied up in the stock market, in real estate, in various financial instruments. When the crisis hit, they watched their net worth get cut in half. Some lost even more. But the people who had a portion of their wealth in physical gold, they had something that held its value, something they could sell if they needed liquidity, something that actually went up while everything else was crashing. That's the power of having real assets in a crisis, not paper promises, not digital entries in a database, physical metal that you can hold in your hand. That's what bullion ownership is really about. Now let's talk about the practical side of this. If you own bullion, where are you keeping it? This is a question that doesn't get enough attention. Some people keep it at home. Some use safe deposit boxes. Some use private vault storage. Each approach has pros and cons. Home storage gives you immediate access, but it comes with security risks and insurance complications. Safe deposit boxes are convenient, but you're dependent on bank hours and bank solvency. Private vaults offer professional security, but you're paying storage fees and trusting a third party. There's no perfect answer. It depends on your situation, your risk tolerance, and how much metal you own. What I will say is this: if you own significant amounts of precious metals, you should have a plan, not just for storage, but for everything. What's your exit strategy if you need to sell? Do you know where you'd sell and what kind of prices you'd get? Have you thought about the tax implications? Do your family members know about your holdings and how to access them if something happens to you? These might seem like boring details, but they're important. I've heard stories of people who accumulated significant precious metals holdings over decades, never told anyone about them, and when they passed away, their heirs had no idea the metals existed. Or worse, they knew they existed, but didn't know where they were stored or how to access them. Don't let that be your story. Here's another thing to consider. The precious metals market is changing. It's becoming more sophisticated, more liquid, more accessible. You can now buy gold and silver through apps on your phone. You can invest in ETFs that hold physical metal. You can use precious metals as collateral for loans. The options are expanding. But with more options comes more complexity. And with more complexity comes more opportunity for mistakes. Not all gold ETFs are created equal. Some hold physical metal. Some hold futures contracts. Some use complex derivative strategies. If you don't understand what you own, you might not own what you think you own. This is why education is so important. Understanding how the precious metals market works, how different products work, what the risks and benefits are of different approaches. It's not complicated once you understand it, but you have to put in the time to learn. And this brings me back to your decision. If you own bullion right now, you've already made the most important decision. You've recognized that precious metals have a role to play in wealth preservation. The question now is whether you're maximizing that role. Are you holding enough? Are you storing it properly? Do you have a plan? Are you staying informed about what's happening in the market? Because here's the thing, the precious metals market is entering a phase that we haven't seen in decades, maybe ever. The combination of factors I've outlined, the central bank buying, the supply constraints, the geopolitical shifts, the monetary system changes, all of this is creating a setup that could lead to extraordinary moves in gold and silver prices. I'm not saying this to create fear or urgency. I'm saying it because it's what the data shows. It's what the fundamentals indicate. It's what history suggests happens when you get this kind of convergence of factors. And if you're someone who's been watching the precious metals market, who's been accumulating bullion, who understands why this matters, then you're positioned for what's coming. You just need to make sure you're positioned correctly, that your storage is secure, that your strategy is sound, that you're not going to panic and sell at the wrong time because you didn't think through your plan. Let me give you one more historical parallel. In the 1970s, gold went from $35 an ounce to over $800. That's more than a 20-fold increase. But here's what most people don't know. Most of that move happened in the last 2 years of the decade. From 1978 to 1980, gold went from around $200 to over $800. The people who sold in 1978 thinking they'd made a good profit missed the biggest part of the move. The same thing happened with silver. It traded in a range for most of the 70s, then exploded from around $6 to $50 in just a couple of years. The patient holders, the ones who understood the fundamentals and didn't get shaken out by volatility, those were the ones who captured the real gains. I'm not predicting that we're about to see a repeat of the 70s. The circumstances are different. The monetary system is different. The global economy is different. But the principle is the same. Major moves in precious metals tend to happen faster than people expect, and they tend to go further than people think is possible. So if you own bullion, if you've done the research, if you understand why you own it, then the decision you need to make right now is simple. Are you going to be patient? Are you going to stick with your strategy? Are you going to resist the temptation to sell too early or panic when there's volatility? Because there will be volatility. Precious metals don't go up in a straight line. There will be pullbacks. There will be periods where it seems like nothing is happening. There will be times when you question whether you made the right decision. That's normal. That's part of the process. But if you understand the fundamentals, if you know why you own precious metals, if you have a plan and you're sticking to it, then those periods of doubt become opportunities. Opportunities to add to your position. Opportunities to strengthen your wealth protection strategy. Opportunities to do what the smart money is doing while everyone else is distracted by short-term noise. And speaking of smart money, let me remind you about something. The central banks I mentioned earlier, the ones buying gold at record pace, they're not doing this on a whim. They have teams of economists, analysts, strategists. They have access to data and information that retail investors don't. And they're buying gold aggressively. What does that tell you? It tells you that the people who understand the monetary system best, who have the most to lose if they get it wrong, are positioning for a major change. They're not buying gold because they think it's going to go up 10%. They're buying gold because they think the current monetary system is unsustainable, and they need to protect their reserves. If that doesn't make you think carefully about your own wealth protection strategy, I don't know what will. Now, before I wrap this up, I want to mention one more thing for those of you who've stuck with me this far. If you're an American retiree with at least $100,000 in retirement accounts, I've put together something special. It's a free one-on-one educational web conference where we go deep into wealth protection strategies, including how to properly structure precious metals holdings within retirement accounts. It's completely educational, no obligation, no pressure. Just information that could be valuable for your situation. Check the description for details on how to access that. Here's my final thought on all of this. The decision you need to make if you own bullion isn't really about whether to buy more or sell or hold. The decision is about whether you're going to be strategic and intentional about your precious metals holdings, or whether you're going to be reactive and emotional. The strategic approach means having a plan, knowing why you own what you own, understanding how it fits into your overall wealth picture, being prepared for different scenarios, staying informed about what's happening in the market, and most importantly, having the discipline to stick with your strategy even when it's uncomfortable. The reactive approach means buying when prices are soaring and everyone's talking about gold, selling when prices pull back and the headlines turn negative, constantly second-guessing yourself, never really understanding why you own precious metals in the first place. Which approach do you think works better over the long term? The precious metals market is at an inflection point. The fundamentals have never been stronger. The setup has never been more compelling. The risks to the monetary system have never been more apparent. If you own bullion, you're positioned for what's coming. You just need to make sure you're positioned correctly and that you have the conviction to see it through. Because when this move really gets going, when gold and silver start making the kind of moves that get mainstream attention, that's when it's going to be hardest to hold. That's when your friends and family will tell you to sell and take profits. That's when the financial media will say it's a bubble. That's when you'll need to remember why you bought in the first place. You bought because you understand that precious metals are real money. because you recognize that the monetary system is changing, because you want to protect your wealth from scenarios that most people don't want to think about, because you're willing to be patient and strategic while everyone else is chasing short-term gains. That's the decision you need to make right now, not whether to own bullion. You've already made that decision. The decision is whether you're going to be strategic about it, whether you're going to have a plan and stick to it, whether you're going to position yourself to benefit from what's coming instead of being caught off guard. The opportunity is there. The fundamentals are there. The setup is there. The question is, are you ready?